Good morning and welcome to our today's class. That is what we call the financial reporting and analysis is the unit that we're going to cover. The financial reporting and analysis. The unit, these are PAP College here, where we offer CPS, CS, CFA, and ATD. So you can reach us through that number. Probably if you're interested with our classes here. So the unit I've said is what we call the financial reporting. Financial reporting and analysis. Financial reporting and analysis. Unit is financial reporting and analysis. So to begin with, we'll first highlight the topics that we'll be able to cover in this unit. And then from there, we'll just be able to begin with our very first topic. Now, topic number one will be on what we call the employees' benefits. I'll begin with the employees' benefits. This is under IAS 19. We'll also get to what we call the public sector accounting, where we'll, generally when we talk about the employee benefits first, if I can explain, employee benefits, we are talking about all forms of considerations that are paid to employees for services rendered. Here we are talking about what we call the short-term benefits like salaries. We are talking about what we call the allowances. We are talking about what we call the sabbatical leaves and all the retirement benefits. All of those are what we call the employee benefits. In our case, we want to know what IAS 19 requires us to account for. The employees' benefits. We'll also get to the second topic we call the public sector accounting. Generally, here we'll just be able to understand on how we account for the government entities. Generally, like the ministries, how do they or how are they required to maintain their accounts? From there, we'll also be able to go to what we call the accounting for agriculture. Accounting for agriculture here is under what we call the IAS 19. Accounting for agriculture, that is under IAS 41, not 19, IAS 41. Now, in this case, when we talk about agriculture, we are talking about the farming activities. And farming activities will comprise of what we call the living plants and what? Animals, which are generally made for what we call the profit generation. So we'll just be able to know in this case, how a farmer or how do we maintain the accounts for what we call the farming activities. We'll also get to what we call the accounting for provisional farms. Accounting for, this is a provisional farms. Now, provisional farms, our concern will be on the advocates. How the advocates will maintain the client's accounts, or how they are also supposed to maintain their own accounts. We'll be able to see in that on what we call in the accounting for provisional farm. Number 5, we'll also be able to talk about the accounting for agriculture, for long-term construction contracts. Long-term, this is a long-term construction contracts. Long-term construction contracts. Now, when I talk of long-term construction contracts, we are talking about those contracts that may take more than, let's say, 1 year, or more than 1 year to be completed. Remember, when we present in financial statements, we prepare financial statement on a yearly basis. And we know for some of the contracts, the initial contract price is normally determined at the start of the what? At the start of the contract. So how do we apportion, how will we be able to recognize the profits for each and every period, the revenue, the profits, and even the gross profit for each and every year? We'll be able to know the methods that we can use in accounting for the long-term construction contracts. We'll also be able to talk about what we call the conversion of partnership into a limited company. Into a limited company. Now, on conversion of partnership into a limited company, this is in the situation where the partners have agreed to convert their partnership business into limited company. Now, in this case, we maintain two sets of books. Now, we maintain the partners' books to close the books of the partners, and we'll also be able to maintain the company's books to open the books of the new company. We'll be able to know in such situations how are we supposed to account for that. Still on the conversion for partnership and of partnership to a limited company, we'll as well talk of what we call the amalgamation. Amalgamation basically is where probably they started as a sole proprietor. They may amalgamate the business to partnership and then end up it being a limited company. In that case, we'll be able to know how we're supposed to also maintain their accounts. Number 7 also, we'll be able to do what we call the financial statement analysis. Financial statement analysis. Now, when we talk of financial statement analysis, generally is where you are analyzing financial transactions to determine their strength, weaknesses, opportunities, as well as threats. Generally, you are doing what we call the SWOT analysis. So in this case, we'll be able to know what are the strengths, weaknesses, opportunities, and threats of a business. When I talk of strength and weakness, here we are talking about the factors that may affect the organization internally. And then opportunities and threat, we are talking about the external environment of a business, the factors that may affect a business on the external environment. So in this case, there are 3 tools that we use when we are doing that analysis. We can use what we call the common size statements. We can also use what we call the comparative statements, and also what we call the ratio analysis. We'll be able to know how we can use those tools to do that analysis. Topic number 8. We'll also be able to talk about what we call the accounting for hire purchase. Accounting for hire purchase. Now, accounting for hire purchase is, we know it is where you take possession of an asset once you pay the deposit, and then for you to pay the monthly installment thereafter. Now, we'll be able to know 2 methods that we use in accounting for hire purchase, the sales method and what we call the interest method. We'll be able to know application of it in accounting for those hire purchase. Number 9, We'll also be talking about the accounting for cooperative, societies. Cooperative societies. We'll also be able to see how cooperative societies are required to maintain their accounts. And then number 10, we'll also be able to talk of what we call the branch accounting. Branch accounting, we are talking about those companies that operate with other branches. So we may find probably we have in what we call the head office, and we may be having the other branches. Here we'll be able to understand 3 types of branches. One we call the dependent branches, and we also have the independent branches and also the foreign branches. We'll be able to know how we maintain the accounts on all those 3 branches, sides of branches. Number 11, we'll also be able to talk about the accounting for assets and liabilities. Accounting for assets and liabilities. Now, when we talk about assets, we know they are economic resources whose benefits flows in an organization for a given period of time. Now, we'll be able to mention most of the assets and some other liabilities. We know how we're supposed to account for them. Like we'll be able to talk about the investment property. We know how IAS 40 requires us to account for the investment property. We'll also do for the property, plant, and equipment under IAS 16. You know what IAS 16 requires us to account for? The property, plant, and equipment, and so forth. Then number 12. We'll be able to talk about what we call the published financial statements. Now, these are financial statements for purposes of publication. For them to be brought to the attentions of what we call the general public. A complete set of summarized published financial statement may comprise of the following. Number 1, it may comprise of what we call the statement of profit or loss, which is basically what we call the income statement. It may also comprise of what we call the statement of changes in equity, the statement of financial position, the statement of cash flows and notes to the financial statement. We'll be able to see how we maintain such complete sets of published financial statement. Here we'll also be able to talk of the business combinations. Business combination. When I talk of business combination, we are generally talking about the group accounts, or what we call the consolidated financial statements. Consolidated financial statements. Consolidated financial statements. Now, when we talk about the business combination, is where we are bringing together separate entities into one reporting entity. That is what we call the business combination. Now, majorly here we maintain it brings to our attention on what we call the foreign subsidiary relationship. Now, this is what I mean. When company A acquires company B, and a company A has acquired more than 50% equity capital of company B, then it means that company B will be a subsidiary. So what we mean is that a subsidiary is any company that is owned by another company for more than 50% of its equity capital. So, and basically in business combination, we only combine or we only consolidate if it is a subsidiary. So, when this probably, let's say it had acquired between 20 to 50%, this one will not be a what? A subsidiary. But generally, this will be what we call an investment in associate. Basically, what we mean in this case, when it is above 50%, we mean you having control. When I talk of control, we are talking about the power to govern the operating and the financing policy decision of the investee. Here, you are having what we call a significant influence. And in the cases of associates, we don't consolidate. However, we account for them using what we call the equity method. Equity method will require us to account for the investment in associate using what we call the cost of investment plus what we call the forced acquisition changes in the net assets. That is something that we'll be able to talk about. And then our last topic here will be what we call the group statement of cash flows. This is basically under what we call the IAS 7. When we talk of IAS 7, we are generally talking about the presentation or the statement of cash flows. Now, statement of cash flows is generally a statement that shows the various sources of cash of an organization and how the cash in this case is utilized in that given organization. Venye unapata pesa and how you're going to use that money in the organization. That is what we call the statement of what? The statement of cash flows. So that is also something else that we'll be able to cover on that particular area or this particular unit. As demonstrated to you, kindly visit our website. So that is what in this case we'll be able to cover. So I will just begin with the first topic that I've been able to highlight there, which is generally what we call the employees' benefits. That is what in this case we'll be able to begin with, the employees' benefits. Employees' benefits. This is under IAS 19. The employees' benefits under IAS 19. Employees' benefits under IAS 19. That is what I want to talk about. The employees' benefits. This is under IAS 19. Employees' benefits. It is under IAS 19. Employees' benefits. And that is under what we call in the IAS 19. Employees' benefits. This is under IAS 19. Employee benefits. That is under IAS 19. Employees' benefits. under what we call in the IAS 19. Now, when we talk of employees' benefits, I've said they are all forms of consideration that are paid to employees, and this is generally for the services rendered. What I mean is that, for example, we may talk of the salaries, the commissions, the bonuses. All of those are employees' benefits. So here we'll be able to know the types of employees' benefits. Like, for example, we'll be able to talk of what we call the short-term employees' benefits. Now, short-term employee benefits are those benefits that become payable within one financial year. Like, for example, the salaries, the commission, the bonuses, those are what we call the short-term employee benefits. We'll also have what we call the long-term employees benefits. Long-term employees benefits, we are talking about those benefits that become payable, and that is in more than 1 year. Generally, here we are talking about the cases of what we call the sabbatical leaves. Then we'll also talk about what we call the termination benefits. Termination benefits are those benefits that become payable either or upon work being terminated by either the employee or the what? The employer. Sasa kama wewe ulikuwa unafanya kazi na useme umeenda, they will pay you the benefits. And then we have what we call the retirement benefits. Those benefits that become payable on a retirement is what in this case we'll be talking about. So just begin and you say on employee benefits. You can begin by saying these are all forms of considerations. Say these are all forms of considerations, all forms of consideration that are paid to the employees, all forms of consideration that are paid to employees, in exchange for services rendered. 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 Same. The objective of IAS 19. The objective of IAS 19 objective of IAS 19. The objective of IAS 19 is to specify the accounting treatment, to specify the accounting treatment, and the associated disclosure requirement, and the associated disclosure requirements, on accounting for employee benefits. On accounting for employees' benefits. On accounting for employees' benefits. Can talk about the types of employees' benefits. Types of employees' benefits. Types of employees' benefits. The types of employees' benefits. Can begin with number 1, the short-term employee benefits. Short-term employees benefits. Short-term employee benefits. And you say these are employment benefits. These are employment benefits. These are employment benefits which are settled within 12 months. Which are settled within 12 months. E.g., you can talk about the salaries, the bonuses. You can talk of salaries, bonuses, salaries, bonuses, bonuses. Talk of commissions, 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 medical cover, medical cover, car benefits, medical cover, car benefits, housing benefits, etc. Housing benefits, etc. Now, those are what we call the short-term employees what? Short-term employees benefits. Number 2 is the long-term employees benefits. Number 2 is the long-term employees benefits. Say, these are employee benefits. Say, these are employees benefits. These are employees benefits. These are employees benefits which are settled in more than 12 months. Just settled in more than 12 months. Here you can have what we call the word sabbatical leave. Sabbatical leave. You know what's a sabbatical leave, Christine? Stefan. Sabbatical leave. What's a sabbatical leave? You're Gregory. You know what's the sabbatical leave? Hmm? No. Now, when generally you are out of work, let me just say this. If a company probably may sponsor you, uende majuu ukasome. Sawa sawa. Sawa sawa. So unaenda majuu kusoma, then ile time utarudi tu bado unarudi kwa kazi na bado anakulipa. Kwa pamoja. Yeah, generally that is what we call in a sabbatical leave. Umeenda, probably you are doing something, ni company imekusponsor, but you are not doing their work. It is your own. Sawa. Yes, that is a sabbatical leave. Number 3, we talk of them as the termination benefits. Termination benefits. Termination benefits. Now you say these are benefits. These are benefits that become payable upon employment or work. So benefits that become payable upon employment or work. On employment or work. Being terminated by either the employee. Being terminated by either the employee or the employer. Being terminated by either the employee or the employer. Being terminated by either the employee or the employer. Now, generally, this is where, for example, you've been working in a company, and I know this normally happens nowadays. Asikia unalipwa years of service. You know? That is what we call in a termination. It's either you have terminated the work or the employer has terminated that job. They have to pay what we call a termination what? Benefits. The last one is what we call the post-employment benefits. Post-employment benefits. Number 4, post-employment benefits, or what we call the retirement benefits. We are talking about the post-employment benefits, or what we call the retirement benefits. What we call the retirement benefits. Or we may talk of them as pensions plan. May talk of them as what we call the pension plan. Now, this is what we mean here. Now, for the pension plans or the retirement benefits are benefits that are paid upon retirement. So, now, in this case, there are two types of what we call the pension plans. There is what we call a defined benefit plan, and we have the defined contribution plan. So when I talk of a defined contribution plan here, we are talking about the benefits payable on retirement, which depends on the amount that has been contributed by the employer and the employee towards that plan. In this case, we can relate with what we call the what? NSSF. So that is a defined contribution plan. It will depend on the amount you, the employer, and the employee has contributed towards that given plan. And then we have what we call the defined benefit plan. And before I talk about this means that who bears the risk of uncertainty here? When I talk of risk of uncertainty, we are talking about the investment risk, because this is just an investment. In this case, the employee is the one who bears the investment what? Risk. When I talk of risk of uncertainty, we mean the risk of not receiving that future benefit. Then we have what we call the defined benefit plan. Now, it is a benefits payable on retirement, which depends on either the final salary or average salary in your career. So, here too, the determinant is the employer. Are we together? Kumaanisha, in this case, the employer is the one who bears the risk of uncertainty. Generally, the investment what? Investment risk. So those are majorly the two types of pension plans. So you write and say on the post-employment benefits or retirement benefits, say these are benefits payable. These are benefits payable. The benefits payable on retirement. Say, an entity should recognize the contribution to defined plan scheme. An entity should recognize contribution to defined plan scheme as an expense. When the employee has rendered the services as an expense, should recognize the contribution to the defined plan scheme as an expense when the employee has rendered the services. When the employees has rendered the services for which the contributions relates. For which the contribution relates. You see, There are two types of, there are two types of pension plans. There are two types of pension plans. Begin with number one, the defined contribution plan. One is a defined contribution plan. The defined contribution plan. On that you say, this is a benefit payable on retirement, or is a pension payable on retirement. This is a pension payable on retirement. This is a pension payable on retirement. Which depends on the amount contributed to the plan. It depends on the amount contributed to the plan. Depends on the amount contributed to the plan by the employer and the employee. Contributed to the plan by the employer and the employee. By the employer and the employee. Say, the employee bears the risk of uncertainty. The employee bears the risk of uncertainty. That is the investment risk. That is the investment risk. That is the investment risk. Now, the second one is what we call the defined benefit plan, number two. Defined benefit plan. Defined benefit plan. Defined benefit plan. That is the second one. Say, this is a pension payable on retirement. This is a pension payable on retirement. This is a pension payable on retirement. Pension payable on retirement, which depends on either the final salary or average salary of the employee. On either the final salary or average salary. Either the final salary or the average salary of the employee. During his career. During his career. Say, it is calculated based on accurate assumptions. It is calculated based on accurate assumption. Based on accurate assumptions. Now, this is what we mean. For them to calculate this, they may say, they may take probably the 2/3 of the average salary, and then they multiply by what? The service what? Service years. That is what we mean the accurate assumptions. Accurate assumptions. That is what we mean there. So, yeah, they can base it on the same. Now you write it down there and you say, accurate assumptions comprises of. Accurate assumptions comprises of colon, and you have Roman 1, demographic assumptions. Demographic assumptions. But one is the demographic assumptions. Demographic assumptions. On that you write and say, this is assumptions about the future characteristics. Future characteristics. This is an assumptions about the future characteristics of the current and former employee, of the current and future employees, former employees, just say that, of the current and former employees, the current and former employees, and their dependent, Say, it deals with matters such as, the mortality both during and after employment, the mortality both during and after employment, the rate of employee turnover, the claims under medical, claim rates under medical plans, Now, Roman number 2 is the financial assumptions. Financial assumptions. Say it deals with matters such as, the discount rate, future salary and benefit level, the expected rate of return on plan asset, So those are the Accurate assumptions. So basically what we mean is that in determination of the benefit payable, the pension payable on retirement, the employee may base on those assumptions, the demographic assumptions, and it may also base on what we call the financial assumption. Demographicals have been able to say the mortality, the claims rate under medical plan, the rate of employee turnover. If you talk about the financial assumption, here you deal with what we call in the future salary and benefit level, may talk about the discount rate, and you may talk about the expected return, rate of return on the plan assets. Write down there and you say, within, you can write a statement there and you say, within the statement of comprehensive income, for the year, the movement is separated into three components. Number one, we have what we call the service cost component. The service cost component. On that you can write and say, this includes the current service cost. And the past service cost, and past service cost, service cost, together with their gains or losses, together with their gains or losses, together with their gains or losses on curtailment, curtailment and settlement, on curtailment and settlement. Now, what do we mean when we talk about curtailment? Curtailment is generally a significant reduction in the number of employees also that are covered by that given plan. So just right there, curtailment is a significant reduction of the number of employees, significant reduction of the number of employees covered by the plan, reduction of the number of employees covered by the plan. So that is on the service cost component. The second component will have it as the interest cost. Interest cost component. Now here we generally talking about the interest on the plan obligation. So the interest on plan obligations. And number 3 is the remeasurement cost. The remeasurement component. The remeasurement component. Measurement components will include the accrual gains and the losses. The accrual gains and losses. This includes the accrual gains and losses. So we can talk about measuring the defined plan assets and the liabilities. And now that measuring the defined plan assets and liabilities. Measuring the defined plan assets and liabilities. Defined plan assets and liabilities. Read and say both defined plan assets and liabilities. Both defined plan assets and liabilities at the beginning of each reporting period. At the beginning of each reporting period. At the beginning of each reporting period are reconciled with the present values. Are reconciled with the present values. Are reconciled with the present value. At the end of each reporting period. The end of each reporting period. The end of each reporting period. So this is what remain, or definitely this is how we do the reconciliation. I love the define. plan asset. Find plan asset. So here we will have the fair value plan asset. This is the balance. Go down. This is as at the beginning. We add the contribution to the plan. To the plan. We also add the return on plan asset. The return on plan assets. Then you less benefits. So this will be the carrying amount. The carrying amount. Now, the carrying amount is what we compare with the fair value of plan asset balance carried down. The fair value of the plan asset balance carried down. So this is as the value as at the beginning. Carrying amount of the value as at the beginning, we will compare with the value as at the end. And then it will tell us whether there is an accrual gain or what we call what? Loss. Now, this is the value as at the beginning. This is the value as at the end. So since this is an asset, if the asset increases kutoka hapa iende hapa ikuje and more value. Like for example, I mean, if this was 23 and this is 28, then this is a gain of 5. So, because this is an asset, and when an asset increases in value, that will be a gain. If the asset reduces in value, like for example, this was now the 28, and here is the 23, then in that case, it will be a what? A loss. Now, we'll also have the define plan liabilities. Fine plan liabilities. So here we'll just have the present value of plan obligation. Now, obligation is a liability. So this is the balance brought down. We have it there. Then you add the current service cost. You add past service cost. You also add the interest cost. Then you less the benefits paid. This will be our carrying carrying amount. Carrying amount we now compare with the present value of plan obligation balance carried down. So we'll compare with this. And then it will tell us whether it's an accuracy or what we call losses. Now, since this is a liability, if a liability increases in value, kama imetoka hapa ikaongezeka, that will be a loss. Sawa sawa. Because when a liability increases, it means it's a loss on your side. When a liability reduces in value here, is when it will be a what? A gain. That is when it will be a gain. That is when it will be a gain. When it will be a gain. Now, this is what I've said. Now, assuming that liability, the carrying amount here is 20. And then our present value is 25. This 5 here, this will be a loss because the liability has increased in value. Sawa sawa. When, for example, this was 25, and then it has reduced to 20. This is a liability may reduce. Ni ukweli. So it can reduce by 5, that will be a what? Again. So inaenda the opposite way of what? The asset. Umeelewa chenye nimesema? Nasema hivi. The key, hii nilisema we are reconciling the amount as at the beginning with the amount as at the end. Kwa pamoja. So let's assume like we've computed the carrying amount. Hapa, hii tukapata 25. Na hii tumepewa ni 30. Sawa sawa. Are we together? Hii ni kumaanisha the liability imeongezeka. Kwa pamoja. When a liability increases to you, is it a gain to you? No. That will be a loss. Sawa sawa. And that means in this case, this will be a loss of 5. Sawa sawa. Now, assuming that this was 38 and this is 30, the liability may reduce. If it reduces a benefit to you, that will be a gain. That is what we mean there. Sawa sawa. Yes. That is what we mean in that. So you can write this example. Can write this example. Write this example. Write this example here. So write and say, So write and say Volta Limited. This Volta Limited operates a defined retirement benefit. Operates a defined retirement benefit. Operates a defined retirement benefit. Defined retirement benefit plan. Defined retirement benefit plan for its employees. For its employees. On 1st January 2014, 1st January 2014, the fair value of the pension plan asset, fair value of the pension plan asset was shillings 2.6 million. Fair value of the pension plan asset was shillings 2.6 million. And the present value of plan liability and the present value of plan liability was shillings 2.9 million. Was shillings 2.9 million. You add and you say, they actually from the word actuarial, the actuary estimated current and past service cost, estimated current and past service cost for the year ended 31st December 2014. The year ended 31st December 2014. Was at 450,000, was at 450,000 and shillings 90,000 respectively, and shillings 90,000 respectively. Say, the pension plan paid, shillings 240,000. The pension plan paid shillings 240,000 on 31st December 2014. On 31st December 2014, and on the same date, Volta Limited paid shillings 730 in the contribution to the plan. In the contribution to the plan. Same. Interest rate on high quality corporate bonds. Interest rate on high quality corporate bonds for the year was 8%. Interest rate on high quality corporate bonds for the year was 8%. Say, as at the year end, the fair value of pension plan asset, fair value of pension plan asset was shillings 3.4 million. Was shillings 3.4 million. And the present value of plan liabilities and the present value of plan liabilities. Present value of plan liabilities was 3.5 million. Was 3.5 million. Say, required. Calculate the measurement gains or losses. Measurement gains or losses on pension plans and assets. On pension plan assets and liabilities. Gains or losses on pension plan assets and liabilities that will be included in other comprehensive income. That will be included in other comprehensive income. That will be included in other comprehensive income for the year ended 31st December 2014. For the year ended 31st December 2014. Now first you can write the NB there. Say the remeasurement gains or losses. When I say remeasurement, generally we are talking about the accrual gains and what? Losses. So should be recognized. Should be recognized in other comprehensive income. In other comprehensive income, in the statement of comprehensive income. In other comprehensive income, in the statement of comprehensive income. In other comprehensive income, in the statement of comprehensive what? Income. Now, generally, this you will find it on when we be talking about the published financial statement. So, in published financial statement, we include what we call other comprehensive incomes. Other comprehensive income may comprise of the revaluation gains, the accrual gains and losses, the foreign exchange losses, the fair value losses or gains on what we call the available for sale what? Non-current assets. So, yeah, so we can have the solution for that question. The solution. So I will begin with the define plan asset. The define plan asset. So let me use shillings in what? I can use them in thousands. So we begin with the fair value of plan assets. Balance brought down. Now, what was the fair value of plan asset balance brought down? That was from the first statement. It was of how much? From the first paragraph. Yes? 2 million, 26. No. So we'll add the contribution to the plan. Add contribution to the plan. Contribution to the plan was of how much? He contributed 700 and what? 30 to the plan. No. You'll also add the return on plan assets. Now, what was the interest rate on high quality corporate bonds? It was 10%, right? So it will just be the 10% of the amount as at the start, which is 2,600. This will be 260. So, and then from there we less the benefit paid. What was the pension that was paid? Pension paid was of how much? Nini? Huh? Nilikuwa nimesema? Or is 8%? 8%. So what is 8% of this? 8% of that? Hmm? 208. What was the pension paid? The pension is the benefits. 240. So get the carrying amount. Get the carrying. Get the carrying amount. 32. Now compare with the fair value of plan assets. Balance as at the end. Was it 3.4? So is it a gain or is it a loss? End of value as at the beginning. Compare with the end. The asset imeongezeka in value ama reduce in value? Huh? So ikiongezeka, is it a gain or loss? Gain. So this will be an accrual gain. Ngapi? What's the difference? Huh? 1 or 2. We also go to the defined plan liabilities. The defined plan liability. So we begin with the present value of plan obligation. They should be balanced, brought down. Ilikuwa ya ngapi? 2.9. You add the current service cost. Was it 450? Yes. What about the past service cost? 90. Then the interest cost. Interest cost is still on the high quality corporate bonds. It is 8%. So it will be 8% of the amount as at the beginning. 2,900. Nakupea ngapi? 230. Then you less the benefit paid. What was the benefit that was paid? 240. So how much is it giving you as our carrying amount? Yes? 36. Sure. 34. 34, 32. Then you compare with the present value of obligation. Balances at the end. What was the balances at the end? 3.5. So this is a liability. Value as at the beginning is 34, 32. As at the end is 3,500, right? So is it a gain or a loss? Yeah, we said when a liability increases in value, that is a loss. A loss of how much? Yeah? 68. So this will be a loss. So unaona nimeweka into brackets because it's a loss. Meaning that now what should we take to other comprehensive income is generally the accrual what? Changes. Sawa. You will have the gain of 1 or 2 minus the loss of how much? 68. We'll take how much? Yes? 34. So these 34,000, remember shillings were in thousands, is what we'll take to other what? Comprehensive income. Sawa. That is what we'll take to other comprehensive income. So you just copy that, then we'll come and proceed from there. So copy hiyo, then tutaendelea toka hapo.